Now we'll see a few revenue recognition issues and we'll see examples from these scenarios. For example, sales return, repurchase agreement, buy and hold, principal agent relationship, consignments, warranties, and non-refundable upfront fees. So let's take an example of sales returns and allowances. On March 5, 2025, Epic Corporation sells 100 video games on account to Go Gamers for $50 each. The cost of each game is $20. Epic allows Go Gamers to return any unused video games within 60 days of repurchase. And Epic estimates that 6 video games will be returned. Cost of recovering of the products will be material, and returned games will be sold to other customers at a profit. So on March 24, Go Gamers returns 4 video games because they are for wrong gaming system. Now, on March 31st, Epic prepares financial statements. And they estimate that 2 more games will also be returned. Now, what are the journal entries Epic should record on these dates? March 5, when they sold the games, and of course March 24 when Go Gamers returned some video games, and at the end of the period March 31st when they prepare the financial statements. Remember, on that day they have an estimation that 2 more games will also be returned. Now let's see how the journal entries will look like. Let's look at here on March 5's journal entries. On March 5, Epic will record their sales revenues. At the beginning, they sold 100 games. If you see the previous slides, $50 each. So all on credit, account receivable debit, sales revenue credit. And for each game, the cost was $20. So they also recorded the cost of goods sold and inventory is credited. This is the basic sales journal entries. Now, this is the sales return journal entries. If you haven't done it in any course, remember sales return is a contra sales revenue. So it reduces your sales revenues. So sales return is a debit item. On March 24, 4 games were returned. So you have to debit sales returns and allowances, $50 each, and at the same time you are expecting to receive less account receivable. So the sales return items will also be adjusted, reducing by the account receivable amounts. So we recorded sales returns here, sales returns debit, and we also here reduced our account receivables. You also need to do the adjustments with your cost of goods sold and inventory. Remember, initially you recorded for 100 games. Now 4 games are returned, so we have to reduce our cost of goods sold, which was an expense and debit item, so we are crediting it. And we will also add back some inventory. So we are debiting inventory, but it's not like pure plain new inventory you are purchasing, it's returned inventory. So we will debit returned inventories. That's the journal entries they will record on the day they receive the sales return. Now remember, on March 31st, nothing happened, but they closed the financial statements and they have an estimation that 2 more games will be returned. So they will also record that estimation. Probably they know that because of the wrong gaming system, the 4 games were returned. The 2 other games are also the same wrong gaming system. Those will be returned. So they need to debit sales returns and allowances. And then they need to credit refund liabilities. Remember, now they didn't receive the sales return yet, but it's confirmed that it will happen. So instead of reducing receivable at this point, we are crediting a liability, refund liability, which is a credit amount. Why we are doing that? We are doing that so that we don't overestimate our sales revenues. You remember the new revenue recognition standards that FASB made. One of the major objectives is that your sales revenue reflects the actual sales revenues. It's easily comparable, and it is of course not overstated. So we adjusted our sales return, which is probable and kind of confirmed. And we also need to adjust with the cost of goods sold. We reduced it, and we also debited estimated inventory returns. So this is we are doing at the end of the year to adjust other sales return, which is kind of confirmed but not yet happened. Now, how they will show all these on their financial statements? For financial statement, they have to report sales revenues. These were their original or initial sales revenues for 100 games. Then they adjusted the sales returns. Remember, this was the actual return, and this is also another return they estimated, which is also confirmed. They have to receive the return soon. So we subtracted sales returns, which we debited. Remember, sales returns are contra revenue. We always debit it. It reduces our actual sales. So our net sales is after subtracting the sales return for all 6 games. Now they will also show cost of goods sold on their income statement under the if you do the multiple step interstatement before calculating the gross income, they will subtract the cost of goods sold from the sales revenues. That's what they are doing it. They subtracted their original cost of goods sold, and then they adjusted. You remember, because of the sales return, they reduced their cost of goods sold. So their net cost of goods sold, they subtracted 1880. So their gross profit on our financial statement will be 2820. Now they will also show the items on their balance sheet. How they will show that? On their asset side, they will show account receivable. This account receivable is the net after adjusting the actual sales return that already happened. Originally, the receivables were 5,000, and then they had sales return on March 24. That time they reduced receivable 200, so they will show net account receivable 4,800. They will also show their inventory here on the asset sides, and they are showing returned inventory, 6 games, $20. Remember, cost of goods sold and inventory we record as per the cost price, and sales revenues, account receivables as per the sales price. So they will record those on their balance sheet asset side, and on the liability side they will show their refund liabilities, and that will be the refund liabilities for those games that they will receive as a sales return. Now we'll see another example, repurchase agreements. Sometimes you will see in the contract there might be some repurchase agreements between the seller and the buyer. That means sellers apparently selling a product, but there is a condition that at some point the seller will repurchase the product from the customer at a later date. And when they repurchase the product again, then the repurchase price could be higher or lower than the first initial price when they transferred the product. Now, if you see that there is an unconditional repurchase agreement, that the customer is receiving the product, the customer is using the product, and after certain period or on a later date, the seller is repurchasing the product. And now you have to compare the repurchase price versus the selling price. If the repurchase price is higher than the sales price, we will consider it as a financing agreement. And whenever it's a financing agreement, remember, you have to consider the interest on it. On the other hand, if you see the repurchase price is less than the sales price, it will be a lease agreement. Now, let's see one example here. Morgan Incorporation is an equipment dealer, sells equipment, and they sold one on January 1st to Lane Corporation for $100,000. And it agrees to repurchase the equipment on conditional obligation from Lane on December 31st, 2026, after 2 years. And look at that, the repurchase price is higher than this original sales price when they transferred the equipment to Lane. because the repurchase price is 121,000 and that sales price on January 1st was 100,000. So according to the chart you just have seen, the repurchase price is higher than the sales price, so it's a financing agreement. So it's kind of a loan, so we have to calculate interest. Now here remember, the buyer is not getting the control over the asset. So Morgan still has the control of the asset, right? Because it can repurchase it, Morgan can repurchase it anytime, and when Morgan repurchases it, and can sell it to anyone else. Right. So when you record on January 1st this transaction, when they transferred the equipment to Lane and received 100,000, cash is debited, but they are not recording it as a sales revenues. Why not? Because Lane is not getting the control. Morgan is still maintaining or continuing the control of the asset. So it's a financing agreement, so they will show it as a liabilities. So liability to Lane Company. Right, so this $100,000, it's kind of a financing they're getting from Lane Company, and in exchange of giving them the equipment that Lane will be using. So here, when there is a repurchase agreement unconditional, you should not record it as a sales revenues. Instead, you will show it as a liabilities. Since it's not a sales revenue, or you are not recognizing the sales, so you are not also recording the cost of goods sold, or you are not crediting the inventory or equipment which is gone for these 2 years. So on January 1st, the journal entry will be cash debit and liability to Lane Company. Now, since the repurchase price is higher, it's a financing agreement, you have to calculate interest, and we assume that the interest rate is 10%. So at the end of the year, Morgan will record interest expense 10% on this $100,000, which is $10,000. Debit interest expense and credit liability to Lane Company. So this is a liability. It's kind of an interest payable. They're not paying it right away, but it's increasing their liability. So it's added back to this $100,000. So next year, again, you will count 1 year's interest expense. Morgan will record 2026 interest expense, but when they count the interest, look at that. The original liability amount was 100,000 on January 1st. Then because of this interest payable or interest expense, they added $10,000 to the liability. So second year's interest will be on 110. And they calculated it 10%, $11,000 interest expense. And then they have another liabilities, $11,000 because of this interest. And then at the end of the year, Morgan will repurchase the equipment from Lane. Lane will return the equipment, and Morgan will pay $121,000 to Lane. So cash is credited, and then you have to remove the liabilities. And we already know how liabilities was created, and it increased because of those interest expenses. This is how you will record a repurchase agreement. And remember, since the customer is not getting the control of the assets, Morgan should not record it as a revenue. Now we will see buy and hold scenarios. There might be a contract between the seller and buyer, and the contract says that the seller is selling a product, but the seller is still retaining the physical possession of the product for a certain period of time. That means the seller is selling the product but is still physically holding the product. So should you record it as a revenue? Right. Although the product is not transferred to the customer, should you record it as a revenue? Because from the very beginning, we saw that you have to recognize the revenue when a product or service is transferred to the customer. Other than that, you cannot. But in this type of buy and hold scenarios, if you see that you made this criteria, then even though as a seller you are holding the product, you can record it as a revenue. For For example, you have to check what is the reason for this buy and hold. Is this reason really substantive, right? Really valid? Because there might be a scenario that you sold the products, but the buyer does not have enough space in their warehouse or storage, and that's why for temporarily or for a certain time period, the buyer is still holding or retaining the product. It's a reasonable and valid situation. Then another condition, the product must be identified separately as belonging to the customer. So the seller can easily identify this product. It's already sold. It belongs to the customer. We are just holding it for a valid reason. The product currently must be ready for physical transfer to the customer. The product is completely ready. Anytime, any point, you are able to transfer the product to the customer, and the seller cannot use the product or direct it to another customer. This point is really important because this kind of identifies that the control is now to whom? The buyer. So the seller has no right to use the product. The seller has no right to sell it or give it to another customer. So that means the buyer has its controls, but for some valid reason, the seller is still holding the product. And if these conditions are met, then you can record it as a revenue. Now, let's see one example. Butler Company sells for $50,000 for fireplace on March 1 to a local coffee shop barista, and the cost of that fireplace is $280,000, and the coffee shop is expanding its locations and may need definitely the fireplace, but under the agreement maybe they are not ready yet to receive the fireplace, or the coffee shop may not have enough space in the warehouses, or they need to wait until the new coffee shops are being built. So for the time being, Butler is still holding all those fireplaces. Physical holding is there, but the question is whether Butler should record these as a revenues under this bill and hold agreement. Right. So title passes to barista at the time the agreement is signed. That means when they sign the contract, the title, those are already transferred to barista. That means now barista is getting the control of those fireplaces. Although Butler is still holding it, and they figured out that it satisfies all those conditions. That means the reasons for the buy and hold are substantive, and Butler can easily identify those fireplaces. Those are already sold to barista, and those products are ready to transfer anytime, and Butler definitely cannot use those fireplaces or sell it to another customer. So they figured out those conditions are fulfilled, and now Butler has every right to record it as a sales revenues. And you already know very basic sales journal entries: account receivable debit for $50,000, sales revenue for $50,000, and you also record cost of goods sold and inventory. Now we'll see a scenario of principal-agent relationships. What is that? So in a principal-agent relationship, principal is the company who actually fulfills the performance obligations to transfer any goods or services to the customers. And there is another party which we call agent who works on behalf of the principal. So you can think of some travel company, travel agents that sells airline tickets, or sometimes when we need to book a hotel or airline or car rental, we frequently use Priceline or kayak.com, right? So for example, you want to do a car rental and you are searching for a cheap price and you are using Priceline, and ultimately you will rent the car from Hertz. So here Hertz is performing the main task, giving you the car service. Hertz is the principal. On the other hand, Priceline is working on behalf of Hertz to sell those services. So Priceline is the agent. Now the question is, how much revenue Hertz will record, how much revenue Priceline will record if you rent a car through Priceline. Right. Remember, Hertz is providing the main service. So Hertz is fulfilling the performance obligation. So Hertz will record the actual revenues. On the other hand, Priceline is working as an agent, and of course, Priceline is receiving some commissions by selling the tickets or by selling the hotel rooms or car rentals. So Priceline will record only the commission as their revenue. So there was a scandal several years ago before these new revenue recognition standards. Before the FASB made these standards, Groupon scandal. If you Google it, Groupon gives us some coupons, right? And you can use those coupons to buy some product or services. Now the question is whether Groupon should record those all products and services that they are selling, giving some discounts as their revenues, or whether the revenue should be recorded by the actual companies, those who are providing those goods and services. Now, there was some revenue manipulation scandals, Groupon scandals, and that's why this principal agent scenario came in. Now, Priceline could say, okay, we are purchasing the tickets from any airways, maybe JetBlues, or we are purchasing the hotel rooms from Hilton, or the car service from Enterprise or Hertz, and then we are selling it to the customers. So even for 2 minutes, we are holding the ownership of the air ticket. So in that sense, we could say that we could record the revenues. No, that would be a false argument, right? Because they are working as an intermediary. If they do so, they are overstating the numbers, they are manipulating the numbers. So this principal agent relationship is really crucial, because we had some previous scandal and fraud cases, or we would say that revenues were not recognized properly because those were not identified or properly mentioned in previous revenue recognition standards. Now let's see one example here. Flyaway is the travel agents, and they sell tickets for British Airways, right? And now the question is, who is doing the performance obligations and how the revenue should be recorded by both the principal and the agent? We just discussed it, right? So here, British Airways is the principal, because the ultimate transportation service will provide British Airways to the customer. So British Airways will record the revenues. On the other hand, Flyaway Travel is working as an agent. So Flyaway is an agent, and Flyaway may receive a commission from British Airways to sell their plane tickets. So Flyaway will only record the commission that they are receiving. They should not record the full amount of the ticket price that they're collecting from the customers, because even though they collect it, they will hold it temporarily. They have to ultimately transfer it to British Airways. And the most important point is that the performance obligations will be provided by British Airways. So British Airways ultimately has all controls of that air transportation or the service, not Flyaway. And that's why the agent should not record these type of services as a revenue. Now we will see an example of consignments. What is consignments? Consignment means that the manufacturer, or some cases the wholesalers, may ship some products to a consignee, but they are retaining the title of the product, or they are still continuing the control of the product. But physically, the products are transferred to a third party, which we call consignee, who will sell the products. So there is a relationship between the consignor and consignee, and you can say that it's kind of a principal-agent relationship. So consignor means the manufacturer who is manufacturing the products, or some cases it could be the wholesalers. So they physically transfer the products to consignee, who could be a dealer or agent, and who will sell the products to the customers. So here, remember, the consignor always retains the title or the control of the product. Consignee is receiving the physical product and selling it, but they are not getting the title or control. So when they sell it, they receive a commission, just like the agent. So they will record actually the commission as their revenues. On the other hand, consignor will record the sales when the consignee actually sells the product. So we will see one example and we'll see the journal entries both for the consignor and consignee. Nelba Manufacturing Corporation ships merchandising costing $36,000 on consignment. The contract says it's a consignment to Best Value store. Nelba pays $3,750 of freight cost. On the other hand, Best Value pays $2,250 for advertising, but that will be reimbursed by Nelba. End of the year, Best Value sold 2/3 of the consigned products for $40,000 cash. And Best Value notifies Nelba that we sold 2/3 of the products for $40,000, and the condition in the contract that they will receive 10% commission on those products that they sold. And then when they sold the products to the customer, they receive the cash. They will transfer the cash to the consignor or Nelba, and we will adjust some other items such as advertising cost and freight cost here. So now let's see the journal entries for both parties. So let's see the consignor, who is still retailing the title of the goods, what the consignor will do. So when consignor transfers the products to consignee, they will reclassify their inventory. This probably is a new type of journal entry. You haven't seen it. At this point, they just transfers or ships the goods to consignee or the dealer who will sell the goods on behalf of the consignor. It's not the actual sales. It's just they are reclassifying the inventory. So they are debiting inventory but labeling as consignment because these inventories are already transferred to sell to consignee, and they are reducing their finished goods inventory, which is $36,000. This is consignor's journal entry to reclassify the inventory. It's not the actual sales, although physically the goods are transferred to consignee, but consignee is not recording anything. They're receiving the goods, but they are not getting any title or control or right on that good. They barely just will sell the goods and get a commission. Then what happened? They also have one freighting cost. When they transferred or shipped the goods to consignee, they paid freighting cost. Remember, this freighting cost is considered as a part of the product cost, or you can say it's also a part of the cost of goods sold. So they pay $3,750 for freight cost. Sorry, it's a freight out cost. So they will credit cash and they will add it to inventory. It's a part of the product cost, inventory cost. So they will debit inventory for those consigned inventory, $3,750, and they paid cash for freight out cost, $3,750. On the other hand, consignee will record nothing. Now here consignee promoted the product and paid for some advertising expenses, which will be reimbursed by consignor or Nelba. So they paid $2,250 for advertising, they credited cash, and they are not recording as advertising expense because it's not their advertising expense, rather it's the consignor's, and they will get the reimbursement. So they debited it as a receivables. So they debited receivables, which is an asset or receivable from consignor, and they credited cash. Now at later date, the consignee sold the products, 2/3 of the products, if you remember from the previous slides, 2/3 of the products for $40,000. So they received cash from the customer to whom they sold, and this cash they have to transfer to consignor. So they cannot record it as a sales revenues. They don't have title or control or right on that product. So they will record it as a payable to consignor. It's a liability. They have to pay it or send it to consignor. So when they sold it, they record it as a cash debit and payable to consignor, and then they notify it to NELBA or the consignor. So when NELBA gets the notification the goods are sold, then at this point NELBA will record the actual sales revenues. So now what they will do, they will record the revenues from consignment sales. This is the revenue recognition. They are recording entire 40,000 as a sales revenues or consignment sales, and then they will adjust all other items and actually how much cash they will receive, not the entire 40,000, because they have to pay for the advertising which consignee already paid on their behalf, which was 2,250, and the contract says that consignee is selling the products on behalf of the consignor and they are getting 10% commissions. On $40,000, the consignee will receive $4,000 commission, so they will debit these two as expenses, advertising expense and commission expense, and the rest they will receive in cash. So they debited cash $33,750. On the other hand, consignee will record this journal entry. They pay or transfer the cash. We'll see how much they pay, but they will remove this payable to consignor entirely, 40,000. This cash, they have no right on it, but they will do the other adjustments. First of all, they paid for the advertising, they got those cash, so they adjusted it. So first they will remove the receivables, they credited the receivables, and they adjust with the cash. So you could show multiple journal entries, or you could just adjust the cash items there because they already received the cash. And they will also receive commission revenues. So the only revenues consignee is recording is the commission revenues, and they are receiving the cash. Again, for commission revenue, you could show a separate entry, but if we adjust everything with the cash amount, the ultimate cash they will pay is $33,750, although apparently their payable to consignor was 40,000, but they adjusted the commission revenues, that $4,000, and they adjusted the advertising, so they paid cash $33,750. And when NELBA or the consignor record the actual sales revenues, they will also record the cost of goods sold. The cost of goods sold is recorded when the sales revenue is recognized, not when the inventory was transferred. So cost of goods sold debit and inventory credit, and they labeled it as consignment inventories. But look at the numbers here. 36,000 was the actual inventory cost. Then we add the freight cost. Freight cost is a part of the product cost, so we added it. We took the total, and we took only 2/3 because only 2/3 products are just sold. So we took 2/3, so we are adjusting it, and we recorded the cost of goods sold for the 2/3 of the products, and we included the freight cost to the actual inventory cost. This is how the consignor and consignee will record the journal entries. Now we'll see the examples of recording warranties. Sometimes when we buy products, we'll get different type of warranties. For some warranties, we don't need to pay anything extra. For example, if you purchase an electronics, they might say, okay, for 5 years, if anything is get defects, or if you need to replace any parts, they'll do it. This is called the assurance type warranty. So this type of warranty comes with the product itself, and it's a part of the sales price. So Again, this type of warranty is included in sales price and comes with the product. It's called the assurance type warranty. Sometimes the sellers may ask for additional warranty. It's the additional service, and for that customers may need to pay separate. For example, if you buy some electronics, they may say, okay, maybe for 3 years you will get this warranty, but if you have any problem after 3 years, you need to purchase this warranty service. This is called service type warranty. Or maybe for some products there will be no assurance type warranty, but they just directly will be asking some service type warranty. That means the buyer needs to pay additional price or amount for those service type of warranty. So when you see this assurance type of warranty, remember it's included with the price and it's with the product, so it will be one performance obligations. But if the customer gets any additional service in exchange of additional price, that will be separate performance obligations, and service type warranties that separate performance obligations, but assurance type is one performance obligations. Let's see one example. Maverick company sold 1000 Rolomatics on October 1st. Total price is $6 million with a warranty guarantee that the product is free of defects. And the cost of the Rolomatics is $4 million, and the term of the assurance warranty is 2 years. So when they sell the products, they said it's free of defect and there is a guarantee, it's 2 years, and they call it the assurance warranty. So for the first 2 years the customer does not need to pay anything, but they said it's free of defects, so if anything happens, Maverick is obligated to replace the parts or provide the warranty service. Now, Maverick also estimates that this assurance type warranty cost will be $80,000. In addition to this assurance type of warranty or the assurance of free of defects products, Maverick sold extended warranty, and that is for 3 years beyond the 2-year periods, and for that they charge additional $18,000. So that means after 2 years, if the customer wants to get more extended warranties, customer will get it for additional 3 years, but they will pay extra $18,000, which is we now call service type. So if they get the service type, there will be two performance obligations. One is the assurance type, another is the service type warranty. November 2, 2025, that means it's the same year, Maverick incurred labor cost and part cost related to the assurance warranty. It's within the first 2 years, so they have to provide those warranty services, so they will record it. Now, Maverick prepares financial statement on December 31st, and for this year, they also estimate that the future assurance warranty will be $44,000. Although they didn't charge it, but it's part of the contract, this assurance warranty, and they estimated it will cost more for them. Now, how Maverick will record all those warranties and sales revenues? Let's see the example here, the journal entry examples. October 1, when they sold those Rolomatics or the products, they sold two. Remember, one is the 1000 Rolomatics, another is the extended service warranty, which is for 3 years beyond the first 2 years period. So they received cash for both on October 1st, 2025, $6 million plus $18,000 for that extended service type warranty. Now, how they will record it? They will record sales revenues for those Rolomatics that they are selling, which is $6 million. But for these $18,000, they will not record it as a revenue, because this is related to that extended warranty, what will happen for 3 years after the first 2 years. So currently this is not a sales revenues, rather it's a liability. So they will credit it as a and unearned warranty revenues. So this is unearned. Now they will also record the cost of goods sold for those 100,000 Rolomatics, and if you go back to the previous slide, you will see the cost of those products are 4 million. So debit cost of goods sold 4 million and credit inventory. Now on November 22nd, they have to provide some warranty services because there might be some defect products or some other issues arises. So they did it, and total they have parts cost 25,000, and they probably replace some parts and some repair cost and labor cost, they have to pay those. So altogether 28,000 they debited as warranty expense. Remember, these are assurance warranties. Customer did not pay any additional things. This is the first year, so they will record warranty expense 28,000, and a part is to pay the labor cost, so salary and wages payable, and 25,000 for replacement the parts. So this is the warranty cost, assurance type warranty cost. Now here, end of the year, they estimated that they have to pay more assurance warranty. So they actually estimated that will be $44,000. So they will debit warranty expense 44,000, and they will credit warranty liabilities 44,000 because these warranties related to the products they recorded this year sales revenues. So they will also record these adjusting entries reflecting the assurance warranty cost at the end of the year. We'll see the last revenue recognition issue example in this chapter is non-refundable upfront fees, how you could record it. Sometimes you will see customers may pay some upfront fees at the beginning of any contract, which is huge, and one-time payment. And then they might have some monthly or reoccurring payment. So how you could record that upfront fees, which is usually non-refundable. And that could happen at the delivery of any product or any services. And that is basically the upfront fees are non-refundable, but you just cannot record the entire amount at the beginning of the year. So we will see some examples. For example, membership fees in a health club. So if you sign up for a health club, you may need to give some upfront fees, then monthly fees. For example, some phone or internet or cable connection, you may need to provide a large amount of upfront fees at the beginning, and then you have to do the monthly fees. So how you will record those? Let's see one example. Erica Felice signs a 1-year contract with Bigelow Health Club, and the terms are that the customer needs to pay a non-refundable upfront or initiation fees, sign up fees $200, and then later membership fees $50 per month. And Bigelow determines that his customer on an average they renew the membership 2 times before they terminate their membership. That means if they have a new customer, it's estimated that they will continue at least or on an average for 2 years. Now for the first month, how much revenues Bigelow would record? So per month they are receiving $50 times 12, that should be yearly revenues, but you have these upfront fees. How we will do that? So here they estimate that the customer on an average will continue for 2 years. So let's calculate this. What would be the monthly fees for here first year, and then they will continue for additional renewal will be additional 2 times. That means total 3 years. So the monthly fees for total 3 years will be 50 times 36, which is $1,800. And then you have these $200 upfront fees. So if we see the same trend for a new customer that they continue the membership for 2 times, which means actually 3 years, So they will receive 1,800 plus the upfront fee, altogether 2,000. Now this 2,000 we can project that they will receive from this new customer for next 3 years. So we will allocate it, and per month if we divide by 36, we will get each month $55.56. Right. So then for first year, how many months passed, we'll see when the contract is signed. Each month on an average we should record 55.56. We'll record it for the first year based on 55.56 for 1 year. This is how we usually adjust with the upfront fees based on the monthly fees and the estimation of how long the customer will continue with us. Now here at the end you will see the summary of those all revenue recognition issues which are unusual, how you're gonna record it. Sales return, you have seen those are the return, it's a contra revenue, how we have to record that. Repurchase agreement, repurchase agreement, you have to look at the repurchase price, whether the repurchase price is higher than the sales price or lower. If it's higher, it's a financing agreement, otherwise we can consider just a regular lease type of agreement. Buy and hold means that you actually sell the products, but as a seller you are still holding the physical possession of the product. Whether you should record the revenue or not, you have to look at the condition, the reasons for buy and hold, and certain other conditions. We also saw the examples of principal, agent, and consignment. Remember, the consignee or agent should not record the entire amount as a revenues, rather it's just the commission fees. And you saw several journal entry problems that you need to practice and know really well. Later we saw warranties, how we will record different type of warranties, whether it's service type or assurance type. And the last example you have seen is the non-refundable upfront fees. So this is all about revenue recognitions, and I have assigned some exercise problems that you need to practice, and you also need to know and practice really well the problems you just here saw on the PowerPoint slides.